This is Cliff Bell with Elizabeth Alcott and Associates here in Napa, California, and this is a video I'm making for my Real Estate Legacy channel. And today I'm talking about the real estate investing basics. And what I'm going to cover today, I'm going to cover the making money with appreciation. That's one of the ways that you do with real estate, and making money by paying off the loan. That's the second thing, and also with tax savings. And then if you're an investor, then there's the additional benefit of depreciation. And then lastly, I'm going to compare this to traditional stock market investing, just at a high level. So that way you can get a comparison of not only what the returns are in real estate, but also comparing it to your one of the other opportunities, which is investing in the stock market. So let me get right into the details now. So let me first start with making money with appreciation. And I'm going to use throughout the whole presentation, I'm going to use the purchase of $500,000 price with 20% down, which is $100,000, and a 30-year mortgage at 6%. The rate's a little higher than that now, but overall, I think over the long period, they probably will be below that, but that's just a number I'm going to use for the math right now. Appreciation national average is about 4% a year. In California, it's a little higher over the last 15 years. It's been more closer to 5, but let's go with the national average because I prefer to be conservative. So the first year of appreciation is $20,000, and what that bakes down to is it's really 4% of the $500,000. And just so you know, that's 20% return on your $100,000 down payment. Not bad. Next, we're going to talk about making money by paying loan back. So when you make your payment on your loan, part of it is interest and part of it is principal. It's a smaller number when you start. But anyway, so we have a $400,000 loan for 30 years at 6%. The monthly payment is $2,940, or about $35,280 a year. Not about, exactly. And that's including principal, interest, and taxes and insurance estimates. So it might be a little different in the property that you have, depending on where you got it. The first year principal reduction is almost $5,000, $4,912. And when you look at your initial investment of $100,000, that's almost a 5% return. And again, over time, the payback grows because as you pay off more of the principal, each year a little bit more gets paid off than starting with $4,912 the first year. And also, I just want to throw in the other part, which is when you have tax savings, because you get to deduct your interest in taxes and insurance and so forth off your taxes. So again, the $400,000 loan at 30 years, 6%, the payments I've gone through, the $35,280. The assumption that I'm using here is 22% tax bracket, and for singles that's between $40,000 and $85,525, and married between a little bit over $80,000 and $171. And so the tax estimate based on, and again this is based on the set of assumptions, is that it's $5,251, or slightly more than 5% in tax savings. So again, another great additional investment opportunity here just because of owning real estate. Now I'm going to talk about making money with depreciation. And I want to point out here, this is only if you're a real estate investor, not if you're living in it, but this is more the business side of it. So this is, all the rest are whether you're a homeowner or not, but this is only if you're an investor. So if you're an investor, you can depreciate your real estate over 27 and a half years. That's just the law. And it's a straight line is used to calculate, and that just means it's the same every year. So you take the $500,000 and depreciate by 27 and a half. And the depreciation then comes out to $18,182 per year that you can write off in your taxes. That only as an investor depreciation. So that's again an additional 18% return on your $100,000 investment. Okay, let's now do a comparison of the stock market versus real estate comparison. And again, this is just for the first year. It will change over time. So the stock market on average, they say 9%. Some people say 10%. It depends on the period that you use. I'm using 9 just to be conservative. But even at 10%, you would get $10,000, or $9,000 if you count the 9%. So when we now look at the real estate, the return is over 30% just as a homeowner, not as an investor. So you $100,000 invested in the first year, you get $20,000 in appreciation. $4,900 in principal reduction, $5,251 in savings. So its total is $30,163 or 30% return on your investment. Now, it doesn't feel the same as the stock market, because in the stock market you have the 9% and you can take the cash out. As a real estate person, it's more of a long-term gain. You don't actually get the cash in your pocket. Depreciation is just the value in the house. And stock market is much more liquid. So selling a house can take a little more time, and you have commissions you have to consider. So it's not as exactly apples to apples comparison, but I wanted to show the difference of what that is. And again, if you add the 18% in for depreciation that you get right off every year, that also changes the calculation. But again, so you can see it's a balanced idea. Stock market is it's much more liquid, and housing is a little more of a long-term hold, but also a very lucrative long-term play. So I hope this was helpful. Please give it a like, and don't forget to subscribe to my channel.